Right. If you own a property or you're thinking about buying one, this is a video you don't want to miss, because right now we're seeing one of the biggest shifts in UK property market in over a decade. House prices are falling in the south, landlords are selling up in record numbers, and a quiet storm is building in the mortgage world that's not really getting the headlines. Everything I'm sharing in this video is backed up from real data and reputable sources. Check the description below for links to every source I reference if you want to dig deeper. I spent over 10 years working in investment banking, specifically on mortgages and loans for a tier 1 investment bank, one of the biggest in the world. And I'm also a property investor myself, so I'm seeing this play out both on paper and in the real world. And there's one trend in particular that I think people are massively underestimating. So let's start with what we can see right now. Asking prices have been falling. In June, Rightmove reported a 0.3% drop when they normally go up this time of year. And in July, the average asking price fell by 1.2%, which is the biggest July fall in over 20 years. That's not normal, especially not for summer. But it's not the same story everywhere. It's mostly the south, London, the southeast, the southwest, where asking prices are really struggling. The north, Scotland's Midlands, like where I am, those are holding up a bit better, some even creeping up in value. Part of this just comes down to affordability. The south got too expensive, and now with borrowing costs where they are, with high percentage rates, people are pushing back. Which brings me to supply. There's a lot more property on the market right now than this time last year. So Rightmove reckons there's about 14% more stock, and sales agreed are up about 5% year on year, but with roughly 14% more homes to choose from, which puts the downward pressure on the prices. Buyers know they have options, so they're not rushing in, which means they can negotiate harder. And that's especially true in places like London, where supply has jumped between 16 to 19%. And surprise, surprise, price growth is basically flat there, or even negative in real terms. But here's where it gets interesting. Why is supply rising so fast? Well, you might remember that back in 2020, average mortgage rates were around 2.4%. Now they're more like 4.5% to 5%, depending on your term. And that's a big jump. For example, if you borrowed £200,000, your monthly mortgage payment might have been around £850. That would have gone up to £1,150 a month. That's around £300 of just the interest, and it's putting on a lot of extra pressure to the homeowner. This year alone, around 1.8 million fixed rate deals are due to expire here in the UK. I'm actually in the same boat. I fixed my actual home in 2021 at 2.5% for 5 years, and next year that's expiring. Luckily I planned ahead for that, but for some other people, especially those who stretched themselves to the limit to buy during the boom, and their income hasn't increased since, that's going to force them to sell up because they just can't afford to pay the extra interest. But this pain of increased interest isn't shared equally. Older generations mostly own their properties outright. I think it's around 61% own the property outright for 65 plus. But the younger homeowners, particularly under 45 like myself, hold the bulk of the mortgage debt for the UK. This isn't about blame. Most people are just doing best with the options they've got at the time. But this is creating a pressure cooker that's driving listings up. And we can't ignore the impact of the government schemes like Help to Buy Equity scheme, introduced in 2013. On the surface, it looked like it was helping first-time buyers, and that was the intention. But it only applied to new build houses, which meant buyers were often locked into buying from developers only who knew they had a captive audience. So in many cases, those developers added a premium to the price. So while it helped with the deposits, it also inflated the prices. And now a lot of those buyers are stuck with less equity than they expected, because their properties are being valued at what they should have been valued for. Now let's talk landlords, like myself, because this is where I'm seeing a lot of change. The number of landlords selling up is the highest it's been in years. In Q1 this year, about 1 in 6 homes listed were former rentals. And honestly, I'm not surprised. You've got higher mortgage costs, tighter regulations, and the Renters Reform Bill set to kick in, which scraps Section 21, tightening rules on rent increases, and then just adding more administration work. It is worth noting though that the Renters Reform Bill hasn't passed into law yet. It's still working its way through Parliament and is expected to come into force by early 2026, though the final details are still being ironed out. For a lot of the smaller landlords, the numbers just don't stack up like they used to, so they're taking the profit that they've made over the years and exiting. And then at the same time, we're seeing more and more properties bought by companies. So over 400,000 buy-to-let properties are now held in limited companies. That number's quadrupled since 2016. And a big part of that shift, in my view, has come after Section 24 was introduced. That change meant that higher rate taxpayers could no longer deduct the mortgage interest from their rental income, which massively reduced the profitability of personally owned buy-to-lets. So for a lot of landlords, the logical step was to set up up a limited company, often as a special purpose vehicle, or SPV, where mortgage costs were still deductible as business expenses. But aside from that, you've also got the corporates, massive funds like Blackstone, Lloyds and pension schemes. They buy up entire blocks of homes, sometimes directly from the developers, so they're never listed publicly, and it's the kind of deals that you or I would never see on Rightmove. So we're shifting away from the small landlords to fewer, bigger players, and that's affecting renters too. Rents are still rising fast, partly because less rental stock is available, and then partly because these big landlords price things differently. They're after long-term, stable returns and likely have investors expecting reliable performance, which puts pressure on them to increase rent, and then that in turn costs the renters money. Now, you've probably seen headlines about 100% mortgages coming back. These aren't your 2007 style free-for-all products that potentially influenced the 2008 crash. They're typically aimed at renters with spotless payment history, and the interest rates are generally higher to reflect that risk. They're not for everyone, but they grease the wheels of the market, especially for renters who have already proven that they can handle the monthly payments. Now, I get why it's being pitched as helping the first-time buyers, but what it really does is support the bottom of the housing chain, which just keeps everyone else moving up. So the net effect is more liquidity in the system, higher prices further up, and more debt risk at the bottom because they're paying the extra interest. And that brings me to the thing that people are most underestimating, and it's this. We're approaching what I'd call a refinancing wall. Millions of people, around 1.8 million, are coming off fixed interest rates in the next 12 to 18 months. And with rates where they are now versus then, some will manage, but some won't. And I reckon we'll see another wave of supply hit the market because of that. Not because people want to move, but because they'll be forced to look for cheaper options. And this doesn't just affect the homeowners. Investors on tighter margins will feel the squeeze even harder. And while some of it might sound a bit doom and gloom, I'm still actively investing in property. I'm not going anywhere. In fact, I think this shift is creating new opportunities for me. So this isn't just a crash like 2008, but it's what I call a slow squeeze. And if you're investing right now, like I am, it's more important than ever to buy based on your fundamentals, which for me are cash flow, local demand, and a solid exit strategy. Don't chase yield if it means going negative every month. Watch your loan to value ratio carefully and make sure the numbers work at today's rates, not just the best case scenario ones because the market looks like it's dipping. I'd actually advise even adding on a % or two as a stress test, just to make sure you're not heading into the red if rates shift again. The opportunities for great investments are still definitely out there, especially in the Midlands or the North, like where I am, but you've got to be sharp and you've got to know your stuff. So if you found this useful, please check out my video over here on how I would begin as a property investor now in 2025 with only £50,000. It's packed with lessons that I've learned the hard way and how I'd avoid the mistakes that I made early on. And let me know what you're seeing in your area. I try to reply to every comment. Catch you in the next one.